Hey, what's up, everybody? Welcome to episode number 35 here on season 2. And today we are getting into how am I handling the market? This question comes from Ryne Huston, and he asks / says, now is the appropriate time. Panic sell, buy more, or hold? Was considering reallocation to 75% stocks, 25% bonds. So what I assume is he wants my opinion on whether I think it's a good idea to do that with 75% stocks, 25% bonds, and then also my opinion on panic sell, buy more, and hold. First of all, these videos are for educational purposes only. They're not meant to be taken as financial advice. You are responsible for your own money and to properly protect that. So do your own research. Anyways, let's go ahead and get into it. So we will break this down into 3 different parts: hold, buy more, and then panic sell. And then I'll give my thoughts on the actual 75-25 rule for stocks versus bonds. So hold, if you think about basic economics, you got to understand that the way that the market is working right now is that there's a huge amount of people trying to sell off their shares or sell off their stock, and there's not a lot of demand in the market. And so what's happening is that the price has to go down so that the demand can meet that supply. And that's what's happening. Whether that why there's so much supply, I don't really know. It could be talks about rising interest rates, fear of all-time highs, and so people are taking their profits, or just that the overall economy here in the United States is actually doing pretty well. I think as a long-term investor, you have to understand how to create demand in a market. And one of the ways to create demand is, first of all, scarcity or rareness. And so what you have to do is by holding stocks, it keeps those stocks out of the market. And so, for instance, if you had 5 or 6 shares in the market, and you held those back, that's 5 shares less. And if there was a lot of investors that did that, it would create a scarcity in the market, and thus the price would then have to go up because the demand would still be there. So that's one reason to obviously increase the price of shares. And then another way to increase it would be to increase the demand, which would be adding new investors or adding new money to the stock market. And that's why I think that holding is always better, because if you think about it long term, if you can create a scarcity in the market along with other investors, then you can again hope to keep that rise up, and that'll happen eventually. It's just a matter of time. Again, we got to come back to equilibrium, and then the demand will start to rise because more and more people will continue to invest their money. So the demand will increase, but the supply will remain the same. And what's happening right now is there's an inverse. There's a huge amount of supply and not a lot of people demanding buying stocks. As far as buying more goes, I think that it's always a great idea, especially if this is in your strategy. But if you continue to buy more while the economy or while the stocks continue to drop, or ETFs more specifically, you'll get a better average cost per share. So for instance, if you were in at $50 and it dropped down to $40 and you bought some at $40, you would bring that down to maybe $45 or $42. It depends how many shares you actually bought. And this buying on the down will help maximize your upside when the market returns. And because you're picking up more stocks, thus picking up more ETFs, thus pulling those out of the buying and selling every day, you're creating more demand in the market. So if you think about that, you're holding, creating more demand, and then you're also buying more, creating even more demand, helping equilibrium come at a higher level instead of at a lower level if you were to sell, which leads me into my third point of panic selling. And my rule of thumb is never let emotions get the best of you in the stock market or in investing in general. This is when you will absolutely lose money, guaranteed. Well, I don't know if it's guaranteed, but more likely than not, you'll probably lose money. Never ever panic sell. Panic selling is emotional selling, and there's just no way around it. That's what it is. You look at the market, it's red, you sell. Why? Because you're emotional. You don't want to lose money. It's understandable, but if that doesn't fit into your strategy, then what good is it to have a strategy if you're not going to follow it? However, I will say always have an exit plan on how you're going to get out of stocks or how you're going to get out of ETFs more specifically, and why. However, this does need to be figured out before the market does drop. So I would say figure out it ASAP before we start seeing more and more red days, or if we see more and more red days, This needs to be figured out. It's not something that can wait. It has to be figured out. So at least you know and have an exit plan and be like, okay, stuff hits this level, I'm out. Stuff doesn't hit this level, I'm still in. I'm still continuing to trade the strategy that I've been trading, or we continue investing the strategy that I've been investing up until that level, up until that exit plan. And then if it hits that exit plan, execute the exit plan. That's simple. And then you also got to have a plan to re-enter the market. When are you going to do that? All that kind of stuff has to be thought out before it actually happens. Because if you don't think it out before it actually happens, you will turn into an emotional trader, emotional investor, and this is never a good idea. So most of these things that I was talking about are in regards to ETFs. Stocks are going to act a little bit different, but ETFs are like mutual funds or exchange traded funds, and so they are actively or passively managed, and so they are going to fluctuate with the markets. And because every single time we've seen a correction, we've seen it continue to rise past the correction. This is what I would apply that to as far as buying individual stocks. If they're strong stocks, or if you understand that they're undervalued or whatever, you could apply the same principles. But this is in regards to specifically ETFs. Let's go ahead and dive into the question of the day, which is, what is the most boring activity imaginable? And the most boring activity imaginable for me would be sitting there absolutely doing nothing. My wife tells me I never take enough downtime. I need to like meditate or whatever it is, and I just like will sit there for 5 minutes. I'm like, I gotta go do something, or I fall asleep. So it's not like I could just sit. If I couldn't fall asleep, it would just be terribly torturous, to say the least. But in regards to the 75-25% bond ratio, that's what I'm currently working towards on my stash account. And then also right now, I currently have that on my Acorns account. So I do like the idea, especially my own accounts. I like to have 25 to 75% invested into bonds. Right now I'm on the lower end because I'm younger, and so I can take a lot more risk. But as I continue to get older, I'll start turning up the bond ratio and be more invested into bonds and less invested into stocks. Anyways, we'll leave it right there. If you have any questions regarding Stash, Acorns, Robinhood, as well as general investing advice, business, Etsy coaching, post those questions down below. Don't forget to subscribe up here and check out my Stash recap, January edition. Check out this other video right here. And as always, thank you for watching. I really appreciate it.